Dear YouTubers, welcome to Real Turkey channel. And this is your loving host, Atilla Yeşilara. I have taken a vacation for a week because I was about to go nuts. That's because I have locked myself at my home since March. And I don't intend to leave my house until someone physically delivers a vaccine to my door and physically inserts it into my arm, because the COVID-19 outbreak in Turkey is something that's completely out of control. These are not allegations. Over the last week, we have seen pro-AKP, pro-government newspapers complain about rising cases and lack of measures to eliminate these. Turkey officially reports 1,500 new cases a day, but the real number could be 10,000 or so. But this is not what I'm going to talk about today. I'm going to talk about Fed's new monetary policy and whether it can bail Turkey out. But first, two things need to be explained. A, what is Fed's new monetary policy? B, why does Turkey need to be bailed out? And then I can get on with my explanation of whether Fed can bail Turkey out, could throw a lifeline to Turkey. Okay, Fed's new policy in its outlines has been pronounced by Fed Chairman Mr. Jay Powell during the Jackson Hole Central Bankers Meet. It will probably be formalized in FOMC's September meeting. Essentially, it's fine-tuning of the existing policy. The existing policy is to tighten monetary policy when, in Fed's estimate, the core PC, core personal consumption expenditures index, is about to rise faster than 2%. Or do the same if the unemployment rate is about to decline below the natural rate of unemployment. Of course, these are rather vague concepts, but this is how Fed acted so far. It has acted preemptively. But now Mr. Powell says, given the fact that inflation has been below our estimates and below our target for a very long time, we are going to wait before we tighten monetary policy for inflation to rise above 2%. Of course, Fed is not going to wait forever. If inflation is becoming sticky about 2%, then it will tighten monetary policy. The same thing applies to output gap or unemployment. Fed will allow deviations from the natural rate of unemployment for a prolonged time to make sure that everyone who can get a job does have a job. Now, these new adjustments to the policy don't seem like much to you or to the women on the street. But actually, given the context in which the world economy operates, they're extremely significant. Or since the 2008 great financial crisis, American core PCE has not exceeded 2%. And it is very unlikely to do so in the near future. The same thing is true about unemployment. I mean, currently I believe there are 30 million unemployed in the United States, and the rate is in double digits. To cut that down to 3.5%, 4% is going to take years. In the best estimates of experts I trust, Fed will keep interest rates at or close to zero for at least 3 years, possibly up to 5 years. This also means that if the demand for dollars or funds in the economy accelerates, Fed promises to print as many dollars as needed so that the borrowing rate remains at zero. This has massive implications for American economy. For instance, mortgage credit will remain cheap for the next 5 years, and private sector fixed investments may increase slightly. But I want to talk about financial assets because that's the angle that impacts Turkey. It stands to reason that if you tell a fund manager or a bank that, look, I'm going to finance you at zero interest rate or at a very small spread to zero interest rate, reflecting your credit rating for the next 3 to 5 years, then anything that yields or has the potential to yield above 0%, say above 0.5%, becomes a lucrative investment. So money immediately floods to new loans or to new asset investments by funds. The money has so far gone to S&P 500 and to a certain extent to emerging market bonds. Now it's going to go to gold. It's going to go to aged wine, stamps, paintings, and of course to countries like high-risk countries like Turkey. Now, before I get to the Turkey's case, I need to explain why Turkey needs to be bailed out. The answer is very simple. Our central bank has run out of FX reserves. I'm sorry. Its official number, $90 billion of gross reserves, is far short of the minimum to cover Turkey's financial debt payments over the next year, and that's the metric used throughout the world. Unofficially, it has no net reserves left. It has wasted all of those in futile currency interventions. I say futile because Turkish lira lost 18% against the dollar. So, according to estimates I find reliable, Turkish Central Bank actually has a negative $40 billion of net reserves. In other words, our central bank borrows money from banks and then turns around and spends it to defend the currency. It's clear that this is not sustainable. At some point, Turkish savers will stop putting their money in dollar deposits or euro deposits in Turkish banks because they would know that the central bank wastes them and the future of their savings are not guaranteed. Or there will be no foreign loans on which Turkey is dependent, and Turkey will have to pay its maturing foreign debt for which the central bank has not enough funding. So Turkey is really in a dire situation. I'm sure you have heard about the natural gas discovery. It's a great positive. I congratulate the government for its determined policy of searching for natural resources, but these are not proven reserves. These are possible or probable reserves. And it will take at least a year to confirm the size and economic feasibility of extracting these reserves. And then another, the government says 3, I say 5 years to bring them online. Our currency shortage is a problem for now, for this winter, whereas the natural gas bonanza, if it comes, Lord permitting, is a story for the next 5 years or after the 5 years. So, how could Fed bail Turkey out? Well, let's look at some numbers. Since the beginning of the year, emerging markets have gone through 2 stages. In the first stage, which peaked in March when the COVID-19 outbreak started, roughly $120 billion of financial capital escaped emerging markets. Since then, it has been coming back. Even ex-China, most of the countries are receiving some type of financial investments in terms of bonds, stocks, swaps, etc., etc. That, of course, increases the reserves of the country, strengthens its currency, and indirectly lowers its inflation. Also knowing that financial investments will continue flowing into one's country allows the central bank to cut interest rates, which stimulates domestic demand. So, after April, the funds that fled from EM returned, albeit slowly, but steadily, and it has helped emerging market central banks cut rates to the bare bone. And even though their economies have not been restored to their pre-COVID-19 glory, they have escaped the worst of the damage. Turkey is an outlier. Exactly the opposite happened in Turkey. Since the beginning of the year, roughly $15 billion of financial capital belonging to foreign investors has left Turkey. And that seems to be completely independent of or unrelated to the COVID-19 crisis. It is very clear that there is something wrong with our political situation or the way our government runs the economy that irritates foreign investors. They don't think their money is safe in Turkey. This is why they keep selling at every opportunity. And that adds to the pressure on the central bank reserves. It wasn't always like that. Remember, the QE policies, or printing as much money as it takes, as European Central Bank former chief Draghi once said, was initiated under former Fed President Bernanke in response to 2008 financial crisis. It's called the QE policies. There has been several variations thereof, QE2, Operation Twist, etc., etc. In those years, Turkey was better managed, and we used to get $30-40 billion of net foreign capital. Of course, not all of it came through financial investment. Some of this was foreign loans, but they're all related to each other. I mean, both financial investments and commercial credits enter a country if it has a solid credit rating, which Turkey doesn't, solid economic and political management. So things have deteriorated since 2012. As a result of this, Turkish stock exchange is extremely cheap. It's cheaper on a PE basis, forward-looking PE basis, compared to the average of major EMs. It's cheap based on its own past. Currently, it trades at around 9 times 2000 and 2002 earnings, and the average is something like that, and the EM average is roughly 12. Bonds offer the highest nominal yield in the world. Domestically, our 10-year bond yields are roughly 14%. And this is like a steal. You can't find that kind of yield anywhere in the world except maybe poor Lebanon or some devastated countries in Africa. But the fact that there are potential lucrative deals out there is not enough to attract investors because they have been burned. How have they been burned? For instance, the Borsa Istanbul, Turkey Stock Exchange Administration, banned short sales, which is a usual custom. As I can buy stocks, I can also express my opinion about them by selling them short. But once you forbid that, the market becomes one way and easier to manipulate. I'm sorry. There has been several investigations concerning foreign investment banks, brokerage houses, etc., to find out whether they are manipulating the Turkish market, both the currency market and the bond market, because there is this pervasive belief among President Erdogan and his advisors that foreigners are trying to undermine his government. So anything that goes wrong in Turkey is blamed on foreign powers and their tool, foreign investment banks. That needs to change. Also, we have closed our swap market by forbidding banks to conduct swap transactions with other parties abroad. Swaps are one of the main instruments foreign investors use to take a position in a country. And we need to open that gate once again so that money can flow to Turkey. And finally, the whole anti-Western stance of the government needs to be moderated. It is perfectly understandable that we will have misunderstandings, disagreements, and conflicts with the West. But that shouldn't turn into xenophobia. We shouldn't blame everything on the West and own up to our own economic inadequacies. Now, even though I am considered a dissident and opposing Mr. Erdogan, I think at the end he's a pragmatic person, and he might, in fact, ease the regulations that make it harder for foreign investors to enter Turkish markets or to recoup their money if they wish to sell and leave. If we can do that, Turkey can survive very handsomely, albeit at a low growth rate, so that the current account deficit will not exceed the amount of money coming in, and wait for the natural gas discovery to turn into reality. What if we don't? Well, if we don't, as several commentators have said, Turkey is flirting with a second currency crisis in 2 years. Remember, the first one was because of the detainment of Pastor Andrew Brunson. Mr. Trump threatened to destroy Turkish economy. Mr. Brunson was released. But in the interim, Turkish lira dropped something like 50% against the dollar. And for a whole year afterwards, Turkish bond yields, Turkish inflation have been higher than the averages. And of course, that was a huge hit to Turkish growth. Now imagine the bad case scenario where Ankara fails to capitalize on the Fed bonanza, continues to pick up unnecessary fights with the West. Biden is elected, who is not as friendly to Mr. Erdogan as Mr. Trump. And foreign banks refuse to loan to us because our credit rating is very low. Turkey will run out of reserves in 3 to 6 months, and we will have either capital controls or default. We will not be able to pay our foreign debts. Either way, never mind the financial aspect, coupled with rising COVID cases, which is turning into the second wave, Turkey will be doomed to a massive recession, probably one of the deepest of its history, and it won't be over in one quarter as it is in most countries nowadays. It will last until Turkey changes policy and, not or but, and a vaccine is discovered that proves to be effective against COVID-19. So once again, we are right at the gates of the Rubicon or at the shores of the Rubicon. And it's up to Mr. Erdogan and his advisors whether we pass the Rubicon in the right direction or sink in the waters. This has been another video by Real Turkey channel. Let me show you our logo so you can locate it easily on YouTube. And I would appreciate if you share it if you liked it. And here is our new English language website, PA Turkey, where content is pretty much similar to what I said. It's skeptical, it's analytical, and it's critical of government, of any government. So, if you want to hear more or read more about Turkey, visit PA Turkey too. And I want to, let me just, and I want to thank you for watching another episode of Real Turkey. Atilla Yeşilada saying goodbye from sunny Istanbul.